A pullback today on the markets. Of course, we do have thin trade because of that Thanksgiving holiday in the United States, and of course only a half session tomorrow. Do you think that's helping to drive the volatility?
It certainly helps to drive the volatility. When we have trading holidays like we do in the States, you certainly see much thinner volumes, and thinner volumes typically will lead to much higher volatility. Traders are able to use the thin volumes to push markets, and even though it might not be done deliberately, you certainly find that the thin volumes lead to higher volatility in markets.
Of course, we had particularly weak markets in Asia this morning. The Nikkei under pressure due to that stronger dollar, and that's putting pressure on their exporters. Chinese market down by 3.6%, and it seems there is some concern about capital adequacy of Chinese banks.
Absolutely. We've seen the Chinese banks increase their credit lending to $700 billion US dollars over the first 9 months of this year. And I think what there's concern now that there might be a requirement for an increase in tightening of the policy in China to increase the capital adequacy ratio. Now, what that might result in is that you might find that the foreign investors into not only China but other developed emerging markets might have to switch out of some of these global emerging markets into perceived higher or lower risk and higher capital adequacy markets. An interesting spin-off, I think, for our market is that this could really go either way for us. If something like this should happen, it could either result in a general sell-off of firstly emerging markets, and in particular emerging market banks, or if this is more specifically focusing on relative capital adequacy ratios between different banks, you might find that South African banks actually look very good on a relative basis and might be net beneficiaries. So it depends very much on how the Chinese policy is defined going forward, and what the interpretation of the developed market investor is on that change in Chinese policy.
Of course, I see a couple of ironies here. The first one is, of course, that South African banks haven't been lending like the Chinese banks haven't, and remain very well capitalized at this stage, don't they?
Absolutely, and that's the point regarding if this is a relative play between global banks. South Africa is certainly looking very good currently on a relative basis from a capital adequacy point of view.
Of course, just looking at China, I mean, the government really has been feeding this lending frenzy by Chinese banks to try and stimulate the Chinese economy. So it would be quite ironic also if they had to then rein in that lending.
Yes, unfortunately, I think the Chinese government finds themselves almost in a situation of damned if they do and damned if they don't. The experience that they currently have in terms of the weakening dollar, and where such a large proportion of their reserves are dollar denominated, are really hurting their reserve position. And as part of their aim not only to diversify their external reserve position, they also try to stimulate the internal demand. And this extending of credit internally is part of that diversifying and stimulating the internal demand. So they really do find themselves in an awkward position where on the one hand they do try and stimulate the internal demand, increasing the credit policies, but at the same time they do need to keep an eye on those capital adequacy ratios.
Well, just looking at the local market, Nerina, we had a very busy week results-wise this week. Today a bit quieter. We did have those first half numbers out of Naspers though. 36% increase in core headline earnings a share, and really looks like it's being driven by pay TV and internet.
Yes, it's a good story almost all round. Certainly on the domestic front, increase of 10% in pay TV customers. I'm not sure if this is a case of the customer voting with their feet and increasing their move from the SABC to the pay TV side, but certainly a very good growth in customer numbers there. But also on the international front, two very good stories there. The contribution from the operation that Naspers owns in Asia called Tencent certainly contributed a lot more than just 10 cents and a lot more than 10%. They contributed, based on our estimates, around 44% of the core headline earnings. So great contribution from Tencent to the Naspers bottom line. But we also find that in Eastern Europe, there's certainly been a great reduction in losses there, and all of this contributed not only to the current set of numbers that are very good, but will probably lead to an upgrade in the numbers for the 2010 and 2011 financial years. And we do have a buy on the stock, and we see that there's more good things coming for this great global company from South Africa.
Do you think there is too much focus on Tencent at this stage, that it is actually making up too much of Naspers' earnings going forward?
I don't think that it's necessarily too much focus. I think it's certainly proved to be a very prudent investment by Naspers, and I think they would certainly not want to see this to grow to be the dominant contributor to their bottom line. At 44%, it certainly is a very chunky portion of it, but I don't think anything to be concerned about just yet. I think they continue to look at investment opportunities around the world, and I think as long as they can continue to balance their investment opportunities in other parts of the world, I don't think we should be too concerned about the contribution that Tencent continues to make to Naspers.
Well, things looking pretty rosy for Naspers. Marion Robertson, MassMart, both out with trading statements yesterday. Not so rosy for them, though, is it?
Yes, unfortunately, the trading update from Marion Roberts not very upbeat, looking at about 15 to 20% lower than the previous comparative period last year. This is in line with our own expectations, but certainly worse than the market, the current consensus in the market is. So we certainly would expect further downgrades on consensus earnings for this company. They're suffering on a wide range of fronts. The strong rand is not doing them any favours. The translation of their earnings in foreign markets have been hurt by the strong rand, and the weakness in the domestic mining and industrial sectors are really causing them a lot of pain. So not a great outlook for Marion Roberts. They have mentioned that their order book has increased slightly to 42 billion rand, so still a very strong order book, but they certainly are suffering from the current economic environment and the strong rand.
And MassMart also seeing a bit of a drop in sales in the first 21 weeks of its financial year.
Sorry, can you just repeat that, Stephen?
MassMart also reporting a drop in like-for-like sales in the first 21 weeks of the new year.
Yes, MassMart, I think, is definitely a reflection of the strain and the extent of the strain that the South African consumer is taking. Certainly a disappointing set of numbers that are coming out of MassMart, and I think it clearly shows that, especially on the durable goods side, where there's less discretion in terms of spending, that the man on the street is really suffering. This is, of course, also an area where credit extension by South African banks is, or rather the lack thereof, is certainly showing its influence on the likes of MassMart, and we don't think that this is over just yet, and we believe that there might be also further downgrades in MassMart, and that the current expectation that is built into the share price is still too high. It's currently trading on a forward PE in the region of about 17, and that's certainly too high for the outlook of the counter as it is. We would rather prefer to be in the likes of a Mr. Price or Clicks, who's a lot more defensive and operates in very much the same sort of LSM space and is supposedly more defensive, but MassMart certainly has a lot more pain to come.